Hey guys, Spencer Coffman here with the Internet Hustler YouTube channel. Today we're talking about life insurance investing. Welcome to the Internet Hustler YouTube channel. My name is Spencer Coffman. Today we are talking about life insurance investing. So life insurance is something that people fight over all the time. Not just the money aspect of it, but they fight over whether or not it is a good idea. People like Dave Ramsey say you got to do term life insurance people with whatever company they're with, whether it's New York Life, State Farm, TD Ameritrade, all these big names. They say that you need whole life insurance. Why? Well, according to the Ramsey side of people, they say it's because they want to steal your money. So the question is, what do you do? Do you get term life insurance? Do you get whole life insurance? Well, if it comes down to those two choices, personally, I would side with the Dave Ramsey side of things because I think whole life is a ripoff. However, nowadays they have tons of different whole life policies. You can get things like custom whole life, universal whole life, variable whole life, all kinds of different things, and a lot of those are way better than whole life, and they're even better than term. And I'm going to tell you why. So when it comes to life insurance investing, I put that investing on there because your life insurance should be an investment. And if it's not an investment, then you have the wrong life insurance. Let's look at a couple different scenarios. So the first one, and again, the type of life insurance you get is also going to depend on your age. If you're toward the end of your life, you probably only need term life insurance because you're not going to have so long to let this investment mature. You want something cheap and you want something that'll pay. If you're at the beginning of your life, you're probably going to want a lifetime investment because it's going to grow. And that's why it's very important that you choose the right life insurance. You want it to be an investment. So let's take a look again at a number of different factors that could influence this decision. In addition, life insurance is a variable all in its own because depending on your health, your lifestyle, your age, your level of physical fitness, pre-existing conditions, family, all of this kind of stuff, the rate that you get could change or it's different. So that'll also play a factor into this. So take what I'm saying as a general basis and then try to apply it to your life and then speak with someone like a financial advisor really where you would get life insurance. If you need to contact someone, you can comment below and I can try to help you find someone. But basically you're going to need to speak with a few different people because what you want to get is what I'm about to tell you. So you got to make sure it checks all the boxes. So let's start out with term life insurance. You can get like a 25-year term life policy for any dollar amount you want really. You can get $250,000. Realistically, that should be the minimum amount that you get unless you are toward the end of life or you just need like an extra $50,000 policy or an extra $100,000 policy, then you could get one of those smaller ones. But generally if you die and you leave, you want to leave enough money behind so that whoever is left doesn't need to worry for at least several years. And $250,000, at least in today's world, is a good enough amount that generally if you were to die, unless you have a ton of student loans, that should be your first priority. Is if you have a bunch of loans, whatever life insurance amount you have should be enough to cover the loans. So that is as a factor to consider in your life. If you have $500,000 in student loans and you were to die tomorrow, your family, unless they're forgiven upon death, if your family is left on the hook with $500,000 in loans, that would be like a pretty bad thing to do to them. So in that case, whatever loans you have out, you should have life insurance to cover those loans. Or you should have money. If you have money in the bank to cover them and you're just making payments, that's fine too. But you should make sure that you have something to cover that loan if you die. So that's really the first thing to consider. Once you've got that taken care of, or if you don't have loans, $250,000 is a really good amount to start with because the price is reasonable And if you were to die, you could leave that behind, and whoever is there, whether it's your spouse or your kids or someone, that would be enough money to continue on. Like, obviously $250,000 does not replace your life, but that's not what we're getting at. We're not going with the value of life. We're going with the value that they need to continue. So $250,000, they could invest $200,000, they could take 50 of it, keep it in a bank account or something, and live on that for a couple years, and let that $200,000 start paying about $20,000 a year if they get it in a decent investment, which then they could just draw the $20,000 a year and the principal would never go down. So that would be a great amount to keep them going, to get them started. They're not going to be rich, but it would be better than something like $100,000, which could evaporate pretty quickly. Of course, if you have a loan, then that amount would just go off to the loans, and then they would start with a clean slate. So you got to make sure, number one, that you have enough to cover the loan. Number two, do you want term or whole life? Well, term life is a lot cheaper. You can get a 25-year term or a 15-year term or whatever type of term you want, and you can get different amounts, $250,000, $500,000, whatever. Let's just say it's $250,000 for the next 20 years. It might be like $50 a month, maybe $100, probably $50. Or you can get whole life, or a term of whole, your entire life that would span for many years. And that you could get a same policy, but the price is probably going to be double or triple. So instead of $50 a month, it might be $150 a month. So the question becomes, why wouldn't I just get a term life policy, pay the $50 a month? That way, if I die between now and the next 20 years, my family gets the $250,000, and during the next 20 years, I can take the difference. So I can take, if a whole life policy was going to cost me $150 and I'm paying $50, I can take that extra $100 every month and invest it in a growth stock mutual fund, like the Ramsey side of people would say, or something like that. I can invest that $100 a month, and over the next 20 years, that'll be worth a significant amount of money. Over 20 years, $100 a month, you would be investing about $30,000 to $40,000. I don't know the math on the top of my head. You could figure it out if you want and drop it in the comments below to help others. But you would be investing about $20,000 to, you'd be investing $1,200 a year over 20 years, so you'd be investing about $30,000 or so dollars. And compound interest over 20 years, that $30,000 is going to be probably several $100,000. So you say, okay, well, if I do that for 20 years, and I die before the 20 years is up, I'll get my $250,000. You won't, but your family will. And then if it's after the 20 years, your $250,000 life insurance policy disintegrates and it's gone. At that point, you could get another term if you wanted, or now you have this investment that's worth more than $250,000 that you have as a backup type life insurance policy. You keep that in there, you can either keep adding to it or not adding to it, and it's worth, let's say it's worth $300,000 at the end of 20 years, and you say, well, now my family has a replacement life insurance policy. And so I was better off doing it that way. You paid the same amount of money, but you got more money at the end. Now, in terms of a whole life policy, that is better. Why? Because in a traditional whole life policy, you'd be paying that $150 a month, and let's say 100 of it is going to your premium. That means $50 is going to your investment. After about 7 to 10 years, you break even, and your investment amount is more than your premium amount, and then when you die, you would get the death benefit of whatever that amount is. So let's say it's $250,000, your family gets the $250,000, your beneficiary, and then what do they do with all that money you paid? Over 20 years, you've paid in about $30,000, same as if you were investing it in like a mutual fund, plus you've paid the premium, so you've paid the $50 a month plus the $100 a month, so you've paid all of that over in the whole life as well, and then you get to keep your death benefit. But then what do they do with the premium amount that you've paid in, that extra money that you wouldn't have? Well, they keep it. And so that's where that becomes a ripoff. However, you look on the other side of it, what happened to that $50 a month that you were spending on your term life? They keep it. You don't get that back. Your term life expired, they keep all those premiums. $50 a month for 20 years. How much is that? Well, that's about $600 a year. 6 times 2, that's 600 a year times 20 years would be $12,000 over 20 years. They keep it. It's gone. And so on the whole life side of things, it would be about double that. So they'd be keeping $24,000. They'd be giving your beneficiary about $250,000 or $250,000. Not about, because it's a premium or it's a policy value amount. So which one would you go with? You want to forfeit 12 or 24, and then at the end they would get 250, or at the end over here they would get 300,000 or more, depending on your mutual fund. So yes, traditionally, this would be a better value. This is very crude, simple math, but you can see the difference that a temporary or a term life, as long as you invest the difference, would be better. But that's the thing. Many people do not have the discipline to invest the difference. So if you are investing the difference, it would work for you. If you're not, then you can't do it. It's not going to work. But with new types of life insurance, you can get custom whole life policies. Now let me explain this to you, because with all of this traditional stuff, where would this mutual fund go? Well, if you could put it in a Roth IRA, that'd be fine, but you're already supposed to be doing that anyway. You can check out a card here about Roth IRAs. You're already supposed to be doing that. So this life insurance additional $100 a month would be something else. Where can you put that? It would have to go into a mutual fund or a traditional IRA, something like that. Well, that $300,000, you're going to pay tax on if you get old enough and you start withdrawing it. So that's going to be taxed. At what percent? Anywhere from 20 to 50%. Taxes usually go up, not down. So let's say 20%, conservatively, 20% of 300,000 is a lot of money. That's 60 grand. So now you're only getting, or your beneficiaries, or you're withdrawing 60,000 less than that. So that's 240,000. Wait a minute, over here on the whole life you were getting 250. Now which is better? And this is tax-free. So it's very, very close. But with a custom whole life, you can invest this money. So it's really a whole life plan with the benefits of this investment side, but they're combined. So you get a whole life policy. So let's say the premium on the policy is $100, and then you're paying $150. So some is going into an investment. After about 7 years, your policy premiums and your investment, you break even, and now you're building. And so what happens is, if at any time you die, you get $250,000. Your beneficiary gets $250,000. In addition, all of the money that you're putting in is going into an investment. Now you can get different rates of returns. You can get guaranteed, you can get variable, and usually it's about 7%. If you go with like a guaranteed, usually you're guaranteed never to earn more than 15% a year and never to go under like 1% a year. And so the average is usually somewhere in the middle, so let's just say it's 7% a year. Now yes, that's less than the 10% that you could be getting, but if this is tax-free, that means 7% tax-free, no taxes, 10% taxed. At the end of 30 years, or of 20 years if it was a 20-year term, and you're going to get taxed 20%, or you're going to get taxed nothing, the 7% compared to the 10% after 20 years and no taxes is going to be about the same or even more anyway. Plus, you're going to get an additional policy value of $250,000. So it's kind of like the best of both worlds. So when you're looking for life insurance, you want to make sure of a few things. Number one, the policy value is enough to cover any loans or debt that you have. Number two, that you are investing in a tax-sheltered, tax-favored, or tax-free type of life insurance policy. Depending on the company, they're going to have different words, different terminology, but the bottom line is when you start pulling money out of the policy, once it is matured, because you don't want to take loans against your policy. You don't ever want to take a loan against your investments because you're losing so much in compound interest that you could be gaining. So just really try to avoid that. So when you come to withdraw it at the end, you want to make sure you're pulling it out, no tax, tax favored, tax free, tax sheltered, something like that. So make sure that that is explained by you to your life insurance broker, your advisor, wherever you're getting the policy. The next thing is you need to make sure that has the right rates. So you want it to be an investment, not simply a life insurance policy. So it has to be some type of custom whole life or a different type of policy. So the money that you're putting in is going toward the premium and it's going into the market as some type of investment. I would prefer that you have, it doesn't matter to me what you do, but my preference for my life is to purchase life insurance policies, again, minimum amount of $250,000, and I really like to have the guaranteed rates because I can go somewhere else and get variable rates at high risk. With cryptocurrency or other types of investments, I can get those 20 to 30% rates of return at high risk. So I want this money that I'm putting in, if it's $150 a month, I want that to be going in at a guaranteed rate of, like, again, 7% average, no more than 15%. Of course, if they make more than 15%, they keep the difference. But if they lose money in a year, you're guaranteed whatever, 4% or 1 or whatever the cutoff is. And then if it averages out, you'll get anywhere from the bottom to the top, 4 to 15. So over the period of 20 years, you're going to average somewhere in the middle, 7 to 12 probably. And again, tax free when you pull that out. In addition, the beneficiary, when they get the life insurance payout, that's usually tax free as well for them as some inheritance, because they were a beneficiary of your policy. Now, we spoke before about having a living trust. So what you should do is have your spouse be your primary beneficiary on a policy, and then if you guys both end up dying in a car accident or a plane crash or something, you would have your trust be your secondary or your contingent beneficiary. So all of the money would still stay right in that trust. Again, it's already yours, it's tax-free that way as well. So if you have any questions about this, please comment below. Life insurance can be very confusing. So the real thing, in my opinion, the best scenario is going to be putting money in with a guaranteed rate that is tax sheltered, tax free, and that is a customized whole life policy. Now, there are a ton of different options, whether you pay it up front, whether you pay one premium a year, whether you pay monthly, whether you do reduced premium, all kinds of different stuff. In addition, some life insurance policies have excellent riders or extra benefits. You can get like disability insurance put into there. You can get long-term care insurance put into there. You can get things like that. So if you have that option within your life insurance, definitely see if you can add them on, because long-term care insurance is something that you're going to want at least when you turn 60. And if your life insurance has it and you're 20 years old, then that's fine, because you're probably not paying that much extra for it. And disability insurance, you definitely need. You're way more likely to be disabled than you are to be killed. So disability insurance would really be an extra thing, and usually you can only get that through work, through your trade, or through a union. So if you can get that through your life insurance and the premium isn't that much more, and it has to be a whole life insurance, then those two benefits of disability insurance and long-term care insurance, in my opinion, are way worth having a whole life, a customized whole life policy compared to a term policy, because then you have that peace of mind that if you ever become disabled, or if you get a critical illness, you can get long-term critical illness, you can get disability, or you can get what in the world? Like the nursing home care. I said it before, but you can get those three things added on that really would make a big difference. And to me, that's like, it's a no-brainer to have that type of a policy to make sure that I'm covered if anything should ever happen between today or even at long-term care when I'm in the nursing home 50 years from now and I need extra care. I've got it covered. In addition, when I would die, the beneficiary receives the full policy amount, plus they receive the full amount of my investment, which would really be about double or triple whatever it would have been if I did a term and an investment. So you can crunch the numbers if you want. If you have any questions, put them below. I'm not your financial advisor, so you'll need to consult with someone to help you figure all of that out. In addition, whoever sells your life insurance policy, they are generally a financial advisor, so you can consult with them. Just remember, try not to have all your eggs in one basket. A lot of financial advisors are locked into a company, and so they're going to sell you what they offer. And a company like New York Life or like Western Mutual or Northwestern Mutual or like Morgan Stanley, they may not have this type of policy that I'm explaining to you. So you're going to have to check with multiple places. So if you do have a financial advisor, check with them first. And if they can't do what you're asking, don't settle for something. Don't give up. Try other places. And a lot of times they're locked in. You know, if you talk about cryptocurrency with a financial advisor, they practically jump out of their skin. So you need to make sure that you're going to multiple places. I know it could be a little bit more complicated, but in the end it'll be highly worth it. If you need any help or you have any questions, please comment below. So do that. Also hit that like button, that subscribe button, and feel free to share this video to help out your friends and family as well, because life insurance is something that can be very confusing, but it is also very important. Till next time.